Hello everyone, DRSN here. Today's video I wanted to do a finance lecture on investing, specifically investing in the stock market. And the definitions, notes, and examples come from this book, How to Adult by Jake Cousine. If I spell your last name wrong, I apologize. So let's start with basic key terms. What is investing, you may ask? A simple definition can be putting your money or resources into something and hope that you will get more money and resources in return. So why should you invest is a rhetorical question, because you should invest because you'll make money in the long term. You'll make more money, you'll grow your wealth more quickly and efficiently. And one type of an investment is a stock. A stock is essentially a fractional ownership of a company that has monetary value, so it's worth money, and a unit of a stock is a share. So you can say that for example, I bought one share of an Amazon stock, which is really expensive, but just to get a gist of it. So what is the stock market? It's like a centralized network of exchanges where buyers and sellers buyers buy investments, sellers they sell their investments. These investments are of publicly that's what it's called. The technical term is publicly held companies. And the stereotype here is that the stock market is a scam. It's a good way to lose money. It takes you taking a risk, but no, you have to invest conservatively. So some term known as conservative investing, which is being in the market for a long time. So you have discipline, commitment, and your time in the market is long. So you want to grow your wealth slowly and stably. So how can you make money from stocks and investments? So when you buy a stock, you buy it at a certain money price. But let's say a year passes after you bought that stock, and let's say you could sell that stock, the stock's value increases. So that's known as appreciation. When the value of the stock or the investment it goes up. A dividend is more of like a payment. The company decides to pay out a portion of its profits to stakeholders. So what does that mean in simple terms? Example could be, let's say you bought one share of a stock of a restaurant company, and let's say the restaurant made $8,000 in a month, and then $2,000 of the $2,000 it made of that 8,000, the owner wants to give that $2,000 profit to his shareholders, and let's say there's 20 shareholders, each have one share, and you're one of the shareholders. So you're 1/20th. You have 5% ownership of that coffee restaurant, because you're 1/20th of a share, and out of the $2,000 you make 1/20th. So you make $100. You just got $100 profit out of that $2,000. So if you invest only in one stock, it's considered risky. It's a risk. So they say, there's a saying, English saying, like, don't put all your eggs in one basket. So you want to you want to have investments in a variety of have publicly held companies and different business sectors. You want to diversify your investments. So as I mentioned this, buying individual can be risky, and a single stock for a company could be expensive. Like, for example, Amazon stock, buying one share is expensive, and you might not have the money. So the solution to where you can diversify your investments at a lower cost, the solution to that is a mutual fund. So what is a mutual fund? Mutual funds are like investments that pool your money to different businesses or company sectors. It's a good way to diversify your investments and is actively managed. I'll discuss what actively managed means, but let me give you an example of a mutual fund. So let's say that you and your two friends each have $200, and you want to buy some tech stocks, but you want like one share of Facebook, which is $300. You want one share of Apple, which is $100. You want one share of Microsoft, which is $200. Individually, you do not have enough money to buy one share of each of these stocks. But if you all combine your money, you and your friends, so each of you get $200, so $600 in total. You combine it total. You can afford to buy one share of each, which will be split among the three of you. So now each of you owns 1/3 of a share of those stocks. This is how mutual fund like works. But instead of like your three friends, like I gave a basic example, it's on a much larger scale. So there's like many investors just like you, with more people, and there's a professional investor who chooses which investments to make for you. So mutual funds are great because they allow you to invest in stocks you would not be able to afford on your own, and they keep you diversified by putting money into different investments instead of like all into one company or one business. On one hand, you don't gain as much with a mutual fund if the company stock increases, but or the investment increases, but you also don't lose as much if one company's stock investment decreases. And so I'll define what actively managed means. So your mutual funds are operated by professional money managers who decide like where and how your money is going to be invested for that specific mutual fund. Because they're making the decision for you, you'll need to your money manager. So it's like a fee. You got to pay a fee because they're trying to beat the market and doing market research. Mutual funds can invest your money in many different sectors and investments. So small companies, large companies, it could be international companies. And now, like, what's in an index fund? I gave an example of a mutual fund. Index fund is like a mutual fund, but it's passively managed. So you're gonna have to manage your account. It's less. It's the money man is a money managers don't won't do the research, and then it'll be like your choice, like which indexes to choose from. I'll go to the next slide. So what's an index? Index, think of it like a playlist of investments that you can choose from. It's like a list used to track part of the market. Think of it, yeah. An index, you consider it as like a recipe. Like the ingredients are the investments from various businesses and sectors. The index fund is like a meal made from the recipe. So like what investment you choose. So an index fund is like, it's more of you have more control. But whereas for a mutual fund, the money manager, your investment manager, he does the research and he wants a fee. Index funds also have a fee, which we'll talk, but the fee is much less because you have more responsibility. Let's talk about metrics. So ROI, this is a famous term not only in the marketing and finance, but in other domains too. Return on investment is your profit divided by the original investment. So let's say you bought one share of a stock. You bought one share for $50. 1 year later, that stock is worth now you bought is $75. So you made a profit of $25. You had appreciation of $25. So the ROI would be 25 divided by 50%. With 25 divided by 50 is 0.5, but in term as a decimal, but in terms of a percentage is 50%. And this is what I was going to talk about, which expense ratio is the fee. The fees in terms of a percentage that you pay back. So if you go back to the top example, let's say the expense ratio is 3%. That 50% you made increase, you subtract the 3%, so your ROI becomes 47%. So you want your expense ratio to be at the minimum. You don't want a high expense ratio because that's going to eat into your profits. And something that I think I should mention is that when you invest in a mutual index fund, make sure ask the investment before you even make an investment. Ask what's going to be the expense ratio. That should be like one of your first things to ask. What's going to be asking a broker or a money manager or investment manager. Ask them like, what's your expense ratio? What will be the expense ratio? The professional money managers or investment managers, they decide how and where your money is invested. Like, I think I mentioned this before, but So let's do key takeaways. So investing is a long-term strategy. Staying in the market for a long time is the strategy for me. That's what I recommend. That's known as conservative marketing, just as a review. Conservative investing, sorry. You don't want to panic sell. Like, don't sell all your investments when you believe the market will crash. Like what happened in 2008. You don't want to just sell everything. You want to diversify your investments through mutual funds or index funds, rather than rather than how do you say it, like investing in one stock. Like, it's a bit risky, so you want to don't put all your eggs in one basket, and obtain a low expense ratio, because the expense ratio eats into your ROI. You want your ROI percentage to be high. Like in the previous example, the ROI is 50%. In real life, like realistically in the real world, your ROI, you want it to be 7% or more. Like this example, it was 50%. That's If that's in real life, then that's pretty good. You're doing great. But in the real world, like, I'm just giving you an example, but in the real world, you want it to be 7% or more, and ask for a low expense ratio. Okay, so that's about it. I'll post more videos. I'll come back to making basketball lectures, but this is it for today's video. Thank you for watching.